If we look at a lot of the concentration in index leadership, what we miss is that those players that are driving a lot of the market, they change. I think that's a really important thing to bear in mind is what happens is people recognize that there's going to be this bottleneck. They trade into the stock becomes fully valued, and then they move on to what they think the next bottleneck will be. So again, long-term investors, that's harder for us to really do, but it's also, I think, the movement away from these names is a recognition that the durability of these earnings might not be as strong as some of the valuations tell us. The other thing that's really difficult is that many of the companies that are being favored in small cap particularly are what we would consider pretty low quality. Many of them have very variable earnings, they're higher beta names, they may have a lot of debt. It's unusual to see them trading at PE multiples in the 30s. They're typically trading in 10 to 15 times PE multiples. And that's just because they're lower quality, more commodity type businesses. It's just the commodity that they're selling right now is strongly in demand. So if I think about it, investors are actually being relatively rational, just a little short-term oriented, pretty twitchy, moving to what they think the next thing is going to be. And I think they've actually done a pretty good job guessing what the bottlenecks are going to be. If we think about how much the Magnificent Seven rallied, there was a good intuition by the market that the earnings growth of these companies was going to be substantial. And that really has been the case. They've stepped into their multiples and proven to actually be even better at growing their earnings in an AI world.